Germany's factories are shutting their doors, unemployment has surged past 3 million, and retail sales are collapsing in real time. Boeing is begging Beijing to buy 500 jets just to survive, while South Korea has been cornered into pledging $350 billion and buying U.S. energy under tariffs it cannot escape. According to Germany's Federal Statistical Office, output shrank by 0.3% in the last quarter, and Reuters confirms Korean factories have now contracted for 7 straight months. Bloomberg warns Boeing's future may depend on this single Chinese order. 3 crises, 1 moment. Europe's engine, America's flagship, and Asia's tech hub are all breaking at once. So if they fall together, what holds the system up? Reuters reported on August 29th that retail sales in Germany fell by 1.5% in July compared to the previous month, far exceeding economists' expectations of a 0.4% drop. Import prices slid as well, a sign of weaker purchasing power and tightening household budgets. The weakness is echoed in the services sector. On September 3rd, S&P Global Services Purchasing Managers Index for Germany slipped to 49.3, its lowest in 6 months, showing outright contraction. The composite PMI, which combines manufacturing and services, was barely above stagnation at 50.5. These readings, taken together, show an economy grappling with a simultaneous collapse in consumer activity and services strength, while industrial production shrinks under tariffs and higher energy costs. On June 12th, Reuters noted that 4 major German economic institutes forecast a return to expansion, projecting GDP growth of 0.3% in 2025 and up to 1.6% in 2026. Their optimism relies on a planned €500 billion infrastructure program and extensive corporate investments totaling more than €600 billion. Yet even these forecasts acknowledge that Germany's economy remains smaller than before the pandemic and heavily dependent on deficit-driven public spending rather than private competitiveness. Economy Minister Robert Habeck insisted in August that the contraction shows an urgent need for action, pointing to reforms on energy prices, labor flexibility, and regulation. Still, questions remain whether fiscal firepower alone can resolve structural weaknesses as cheap Russian gas disappears and imports of U.S. liquefied natural gas lock in higher costs. While Germany scrambles to stabilize, across the Atlantic Boeing faces its own reckoning. On August 21st, Bloomberg reported that Boeing is in talks with Chinese buyers to sell as many as 500 passenger jets, potentially the largest order in the company's history. According to the Wall Street Journal, the order would be the first significant Chinese purchase of Boeing aircraft since 2017, when relations soured during Trump's first term. Chief Executive Kelly Ortberg has acknowledged that clearing pre-2023 737 models is only possible with a breakthrough in China, making the deal central to Boeing's financial survival. Yet the negotiations are tightly bound to broader U.S.-China trade discussions, meaning a single court ruling or diplomatic rupture could derail years of preparation. The scale of the order matters because Boeing's backlog currently sits at more than 6,500 planes, yet only about 3% of those are destined for China, according to Barron's. Airbus, by contrast, has surged ahead in the Chinese market, leaving Boeing with dwindling leverage. At the same time, the Chinese manufacturer Comac has begun to accelerate deliveries of its C919 narrow-body jet, reaching 48 aircraft delivered in 2024. This expansion signals China's long-term intent to reduce reliance on foreign suppliers altogether. Boeing's push for a mega deal therefore looks less like a strategic victory than a desperate gamble to maintain relevance in a market where it is already losing ground. The negotiations highlight an uncomfortable parallel with Germany's weakness reliance on Chinese markets. Just as German exports are squeezed between Chinese manufacturing dominance and American tariffs, Boeing's survival now depends on Chinese purchasing decisions that serve Beijing's broader geopolitical goals. If China agrees to buy the aircraft, it will not simply be to help Boeing, but to use the order as leverage in its negotiations with Washington over tariffs and technology restrictions. If Beijing declines, Boeing risks falling permanently behind Airbus and Comac. Meanwhile, South Korea is being pressed into concessions that carry long-term consequences. Politico reported on July 30th that Trump's administration struck a provisional trade deal with Seoul that reduced tariffs on Korean exports to 15% from a threatened 25%. In exchange, South Korea pledged to guarantee $350 billion in investments and purchase $100 billion of U.S. energy products. Reuters added on September 1st that negotiations leading to this agreement were acrimonious, with Korean officials clashing with U.S. Commerce Secretary Howard Lutnick over how much of the fund should be direct investment rather than loans or guarantees. Despite Seoul's compliance, the Bank of Korea projects that these terms will reduce South Korea's GDP growth by 0.45% in 2025 and by 0.5% 0.6% in 2026. On September 1st, Reuters reported that South Korea's factory activity contracted for the seventh consecutive month in August, with the Purchasing Managers Index sinking further under the pressure of U.S. tariffs. South Korea, once the world's most competitive shipbuilder, now faces a China that produces more than half of all new ships globally, leaving Korean yards increasingly uncompetitive. In semiconductors, where South Korea's Samsung and SK Hynix once led, Chinese investment in domestic chip fabrication has eroded their dominance. With tariffs closing off alternatives, South Korea finds itself forced to align more tightly with Washington even as its competitiveness diminishes. On September 3rd, Reuters reported that Trump warned he may be forced to unwind trade agreements with the European Union, Japan, and South Korea if the Supreme Court rules against his tariff authority. Such a decision could destabilize the very agreements underpinning Boeing's negotiations and South Korea's concessions, casting doubt over whether these hard-won compromises will survive legal scrutiny. If the court strips Trump's ability to impose tariffs unilaterally, the scaffolding of his trade war could collapse, taking with it Germany's forecasts of relief, Boeing's hopes for Chinese sales, and Korea's provisional tariff guarantees. This raises a broader question. Are these three stories truly separate, or are they facets of the same underlying fracture in global trade? Germany's contraction exposes the vulnerability of industrial economies deprived of cheap energy and export markets. Boeing's reliance on Chinese purchases highlights the fragility of U.S. industrial champions in the face of global competition. South Korea's coerced commitments reveal how even technologically advanced allies can be cornered into disadvantageous deals. Each case demonstrates dependence on temporary fixes, fiscal spending in Germany, potential orders for Boeing, and forced investments from South Korea, rather than sustainable growth strategies. The cumulative effect is, well, a world economy bound by precarious bargains. Germany's stimulus can buy time, but not energy independence. Boeing's China deal can fill order books, but not reverse a structural loss of market share. South Korea's concessions can secure temporary tariff relief, but not restore competitiveness against China. And all of these depend on legal rulings, political will, and fragile diplomatic negotiations. None guarantee stability. If Germany fails to reignite its industrial machine, Europe risks deeper fragmentation as other economies turn inward. If Boeing fails to secure the Chinese order, America's largest exporter could slide further into state dependence, a trajectory already visible in Washington's push for partial government ownership of key defense contractors. And if South Korea buckles under the weight of U.S. demands, it may find its economy trapped between Chinese competition and American protectionism, unable to chart an independent course. What does it mean if three of the world's most advanced economies, Germany, the United States, and South Korea, are simultaneously dependent on China's purchasing power, U.S. tariffs, and government spending? What does it mean if growth forecasts rest on conditions that may never materialize? And what happens if all three gambles fail at once? As September's trade negotiations continue, the facts leave little room for certainty. Germany's economy shrank more than expected. Unemployment has topped 3 million and consumer demand is collapsing. Boeing is in talks for a massive Chinese order, but its future depends on trade deals that could be torn apart by courts. South Korea has pledged hundreds of billions under duress, but its factories remain in contraction. The fragile bargains underpinning each case suggest not resilience, but dependence. The final beat arrives not as a resolution, but as an open question. If Europe's largest economy, America's flagship manufacturer, and Asia's most advanced technology hub are all trapped in crisis at the same time, who exactly is left to hold up the system? Germany's struggle is deeper than quarterly GDP. Eurostat reported in September that household consumption has fallen below half of GDP for the first time since reunification, leaving Europe's largest economy dependent on public spending rather than private demand. Bloomberg calculated that foreign investors pulled more than 40 billion euros from German equity funds in the first half of the year, the sharpest flight since the euro crisis, stripping away the capital base needed to finance recovery. Boeing faces its own timer. Reuters revealed in August that more than 70% of its debt matures within 5 years, raising refinancing risks while U.S. interest rates stay above 5%. The Financial Times added that European officials fear Boeing could be turned into a U.S. policy tool, with sales tied to political leverage rather than market demand. South Korea's concessions echo the same fragility. Yonhap reported that Seoul will issue $30 billion in new dollar bonds before year-end to fund its U.S. commitments, exposing itself to currency risk as the won sinks to its weakest level since 2009. Austerity, debt, and coercion are holding the system together, but only barely. The real question is no longer whether these economies can adapt. It is whether the global order itself is being rebuilt on terms none of them can control. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.